We recently released our annual report called Corporate Compass that we've titled State of the Art versus the State. And that really illustrates the tension we see between technology and the velocity of policy change taking place around the world. The report this year really suggests several action items. I think first and foremost is remaining nimble when it comes to policy. And that really means having a policy action framework in place to anticipate and prepare for the kinds of policy volatility we've seen in the past year and potentially in the years to come. Second, I'd say it's always important in a period like this to be stress testing your liquidity. And in a market today where we illustrate how risk premia are at or near historic lows, we believe that now is a perfect time to go up and shore up any disconnects in that stress testing and liquidity optimization process. And third, I think it's a great time to reassess the effectiveness or return on investment on technology investment specifically. AI is going to have a lot of impacts on the broader economy in the year ahead. We're going to see it in areas like the debt capital markets, which are increasingly going to be a source of capital for large hyperscalers. We anticipate that almost a third of net new issuance may be coming from hyperscalers and corresponding technology companies that are investing heavily in AI. But it's also going to have impacts on things like energy and power prices and just general affordability. The US remains an incredibly attractive location for capital. We see that most clearly in the US equity capital markets, which have continued to trade at a material premium to the rest of the world for several years now. We believe that's driven by a number of different factors. One is durable growth, driven not the least of which is by the trend of AI, the deregulation trends we see on the policy side, and the deep and robust capital markets from a liquidity and pricing perspective as well.
The valuation gap for Europe versus the US remains a theme into 2026. The valuation gap has widened to 8 to 10 turns for the US trading above Europe. That's above the historical average of around 4 to 6 turns. If you look at the equal weight indices, which then will control for the largest stocks, that differential has actually stayed constant at around 2 to 4 turns. It really says that it's not a one-size-fits-all, as European companies are looking to tap into either the US capital markets or evaluate US opportunities. When it comes to cross-border M&A, firms are seeking to acquire growth at the most attractive costs. And when we evaluate the information on valuation multiples and growth across multiple markets, we actually find that the US midcaps and UK midcaps trade at very attractive growth-adjusted multiples. When you combine that with the fact that European companies are also trading at a growth-adjusted multiple discount to their 10-year average, all of these are supportive that cross-border M&A opportunities will persist. So for 2026, European corporates can remain competitive for the long term by the pursuit of focused scale. We find that the largest pure play companies in Europe traded a 5-turn premium to the large diversified companies, which is at a record high. So corporate clarity will be a continued theme. The second is around catering to the global investor. We actually find that growth rules the day, but the US investor is willing to pay more for that growth. The third is around leveraging AI. CapEx spend in Europe is only about 1/2 of that of the US, and the scarcity valuation premium for AI exposed companies is real. So to the extent that companies can position themselves as such, that will be very valuable.